Final section, and that is on exchange rates. First of all, let's look at the nominal exchange rate, and it's the rate at which one country's currency trades for another. We express all exchange rates as foreign currency per unit of domestic currency. So in essence, an exchange rate is a barter of my currency for your currency. Now, some exchange rates as of today, I just did this, the 8th of July, 2010. The Canadian dollar, $1, $1 US dollar buys $1.04 Canadian. $1 US dollar buys 0.8 euro. One US dollar buys 88.5 Japanese yen. And one US dollar buys 12.25 Mexican pesos. Now, exchange rates, you can get an exchange rate at any point in time, but exchange rates are always moving. They're either appreciating, strengthening, so there's an increase in the value of a currency as measured in the amount of foreign currency it can buy. That's appreciation. So if the dollar buys 14 Mexican pesos tomorrow, as opposed to 12 today, the dollar has appreciated. There's also depreciation, which is a decrease in the value of a currency as measured in the amount of foreign currency it can buy. So if the dollar instead buys 10 Mexican pesos tomorrow as opposed to today, the dollar has depreciated in value. Now, as one country's currency appreciates, the other country's currency by definition depreciates, and vice versa. If one country's currency depreciates, the other currency by definition is appreciating. Now, during 2007, the US dollar depreciated 9.5% against the euro, but it has been appreciating against the euro, and it appreciated 1.5% against the South Korean won. Now, do changes in exchange rates affect people? You bet you they do. For businesses, export-related businesses, they do not want an appreciation of the US dollar, since that will hurt US exports and thus US businesses. Depreciation of the dollar will help US exports and help US businesses. So export-related businesses actually wants a depreciation. Tourists, on the other hand, want an appreciation of the US dollar. That will help US tourists and will increase their purchasing power. Depreciation of the US dollar will hurt US tourists by decreasing their purchasing power. So I'm going to be going to Austria in Christmas time, and so I want an appreciation of the US dollar. Similarly, I'm going to Japan in the summertime. I'm doing a lot of traveling, and I want an appreciation of the US dollar. But I also know that that same appreciation will hurt US exports. Now, we're going to go into something called the real exchange rate, and this gives a more nuanced view of the exchange rate. And basically, we're going to manipulate the nominal exchange rate to see how much, in terms of goods, how much one US Big Mac can buy of a Japanese Big Mac, for example. So let's look at it. The real exchange rate, the rate at which the goods and services of one country trade for the goods and services of another. So in other words, a US Big Mac can buy how much of a Japanese Big Mac? The real exchange rate formula is E times P divided by P star, where P is the domestic price, P star is the foreign price, and E is the nominal exchange rate, i.e. foreign currency per unit of domestic currency. Let's do an example with one good. A Big Mac costs $2.50 in the United States, 400 yen in Japan. The nominal exchange rate is 120 yen per dollar. E times P is the price of yen of a US Big Mac, and that is going to be 120 yen per dollar times 250 per Big Mac. 300 yen per Big Mac. Compute the real exchange rate. 300 yen per US Big Mac divided by 400 yen per Japanese Big Mac. And that is going to be 0.75 Japanese Big Mac per US. So a US Big Mac can buy 0.75 Japanese Big Macs. And because we're able to compare yen to yen, we're converting the Big Mac in the US into its yen price. Interpreting the real exchange rate. 0.75 Japanese Big Macs per US Big Mac. Correct interpretation: to buy a Big Mac in the US, a Japanese citizen must sacrifice an amount that could purchase 0.75 Big Macs in Japan. Okay. So the Japanese person doesn't need to sacrifice as many Big Macs, Japanese Big Macs, to buy one US Big Mac. Okay, active learning exercise, compute a real exchange rate. And we've got the nominal exchange rate of 10 pesos per dollar, which I guess is the Mexican. Price of a tall Starbucks latte is $3 in the US, 24 pesos in Mexico. What is the price of the latte measured in pesos? Calculate the real exchange rate measured as Mexican lattes per US latte. Okay. Alright, what is the price of a US latte in Mexico? And it should be 30 pesos per US latte. And calculate the real exchange rate. 30 pesos per US latte, 24 pesos per Mexican latte. Therefore, one US latte buys 1.25 Mexican lattes. Okay, the real exchange rate with many goods. P, the US price level, consumer price index, measures the price of a basket of goods. P star is the foreign price level. The real exchange rate is the price of a domestic basket of goods relative to the price of a foreign basket of goods. If the US real exchange rate appreciates, US goods become more expensive relative to foreign goods. Law of one price, the notion that a good should sell for the same price in all markets. Now, suppose coffee sells for $4 a pound in Seattle and $5 a pound in Boston and can be costlessly transported. Now there's an opportunity for arbitrage, making a quick profit by buying coffee in Seattle and selling it in Boston. And what that in essence is going to do is going to raise the price in Seattle and drop the price in Boston, and so the price of Starbucks coffee is going to be equalized between Seattle and Boston. That's exactly what I just said. Drives up the price in Seattle, drives down the price in Boston until the two prices are equal. Now, purchasing power parity is going to carry this a little further. It's a theory of exchange rates whereby a unit of any currency should be available to buy the same quantity of goods in all countries. Based on the law of one price, implies that nominal exchange rates adjust to equalize the price of a basket of goods across countries. Let's say the basket contains a Big Mac. P is the price of a US Big Mac. P star is the price of a Japanese Big Mac. And we have the exchange rate yen per dollar. According to PPP, E times P is equal to P star. So, okay. So the prices are going to be equal with the exception of the exchange rate. So here is the price of a US Big Mac in yen. Here is the price of a Japanese Big Mac in yen. So if the two items can be costlessly transported, the price of the US Big Mac times the exchange rate is going to be equal to the price of the Japanese Big Mac. So let's see if they give an example here. Solve for E. E is equal to P star over P. So let's say that the price of the US Big Mac is $1 and the price of and the exchange rate is 100 yen to the dollar. So that would mean that law of one price, that the price of a Japanese Big Mac should be equal to also 100 yen, since the price of a US Big Mac in yen is equal to 100 yen. Okay, PPP and its implications. PPP implies that the nominal exchange rate between the two countries should equal the ratio of the price levels. If the two countries have different inflation rates, then E will change over time. If inflation is higher in Mexico than in the US, P star rises faster than P, so E rises. The dollar appreciates against the peso. If inflation is higher in the US than in Japan, then P rises faster than P star, so E falls. The dollar depreciates against the yen. Now, limitations, 2 reasons why the exchange rates do not always adjust to equalize prices across countries. Many goods cannot easily be traded. Haircuts going to the movies. Price differences cannot be arbitraged away. Foreign goods, domestic goods are not perfect substitutes. Some U.S. goods prefer Toyotas over Chevys. And also, foreign goods cannot easily be traded across country borders. There's such a thing as customs that throws on a tariff that is designed to keep the prices separate between the two items. Price differences can reflect trade differences. PPP works well in many cases as an explanation of long-run trends. PPP implies that the greater the country's inflation rate, the faster its currency should depreciate relative to a low-inflation country like the US. The data support this prediction, and here we have inflation and depreciation in a cross-section of 31 countries. Japan has low inflation and low depreciation of its currency. So does Canada. Kenya is getting up there. Argentina, Mexico, Romania, Brazil. These countries have high inflation and high depreciation of their currency. So the relationship of inflation to depreciation definitely holds. And Ukraine, very, very high inflation and depreciation. Now, this is an example of what happened in the German hyperinflation. The German price level went up dramatically, and so between 1921 and 1925, inflation went up from just above maybe 10% to somewhere in the neighborhood of 10 million%. Money supply went up exceedingly, and the exchange rate depreciated dramatically because of the increase in the price level. Okay, our chapter summary. Net exports equals exports minus imports. Net capital outflow equals domestic residents' purchases of foreign assets minus foreigners' purchase of domestic assets. Every international transaction involves the exchange of an asset for a good or service, so net exports equal net capital outflow. Saving can be used to finance domestic investment or buy assets abroad. Thus, savings equals the domestic investment plus net capital outflow, and that was the national income identity equations we were looking at. The nominal exchange rate is the relative price of the currency of two countries. The real exchange rate is the relative price of goods and services of the two countries. Finally, according to the theory of purchasing power parity, a unit of any country's currency should be able to buy the same quantity of goods in all countries. The theory implies that the nominal exchange rate between the two countries should be equal to the ratio of the price levels in the two countries. It also implies that countries with high inflation should have depreciating currencies. And this, I think, is the end of open economy